the long problem, the one you have to
Do you know you need to find it in the book?
Yeah,
that's the
that's
only
what
way I'm gonna be able to do it is if you tell me which one it is in the back of the book. Okay, so I'm just gonna go over a couple of things. Budget process. So there are at least 6 items that complete the budget process. What do you think the first one is?
sales.
Sales? No, that's a type of budget.
Operating budget.
That's a type of budget. We're talking about the process.
Oh, process.
Process. Budget process.
Strategic budget.
How about that's part of it, but not so much. Let's start with converting the long-term strategic plans, which is what Ms. Cedro is talking about, to short-term, what type of plans?
Financial plan.
Yes, convert long-term strategic to what? Short-term financial plans, right? What do you think the next process is? That's one.
Evaluating business operations.
Say it again, I'm sorry.
Evaluating business to pass and
so benchmarking, correct? Benchmarking for the purpose of just evaluating performance and communicating the plans that management have throughout the whole organization, because you know how management can make plans, but only the management team knows those plans. So the purpose of just benchmarking is to get it out there to the entire organization. So that would be the next plan, is to benchmark plans. What do you think comes after that?
Relating it to employees.
How about we coordinate? So we coordinate activities that will help the company contribute, or help the entire organization contribute to the goals for that organization. So we want to say that we are going to just enhance some type of, or just provide coordination, right? To enhance organization to meet goals. What do you think comes after that? We should probably, if we're going to put activities in place to where the organization can meet those goals, at that point we are thinking about what? What are we focusing on? What do you normally focus on when you're making out plans and goals for yourself? You're looking at your what? Your future, right? So the focus needs to be on the future. That would be the next process. Focus on future, right? And next, if you're focusing on your future, on the future of the company, we should say, what would you have to do in order for everybody to be able to do that? Communicate, right? So you have to communicate that to the entire organization. And what do you think is the last process?
Reporting.
Basically the budgeting process, but we have to motivate the people that are a part of the organization to be a part of that budgeting process. Like for instance, we know that managers or management does the budgets, right? But employees do contribute to that too. Because you think about all the different budgets that they have, management can't be responsible for all of that. they have to know those who are involved in the organization, right? So we want to motivate employees to be a part of the budgeting process. Okay, good. So that's very key, right? Now let's talk about what you have, and I'm on page 901 at this point, I believe. No, we just talked about it. I'm sorry, 902. So the budget committee, what is their role? Who is the budget committee? Who is a part of that? Administration. Who's the main, the top? We don't call them administration. What do we call them in managerial accounting? What do we call them? In managerial accounting. Management, right?
Yeah.
So there's management from all departments that are a part of this budget committee. And what is their potential or main goal? If they're a part of the budget committee, what is the main goal? It's not just to prepare budgets, but to do what?
To make sure get every management involved.
They want to make sure that they are, one, coordinated, and two, realistic. You don't want to just put a budget out there that you know each department cannot what? Maintain or meet, right? So their sole purpose is to make sure that it is coordinated properly, meaning you will not have a production budget without a sales budget, and you also want to make sure that it's going to be realistic goals for them to meet, right? So this is how it kind of goes, because with management we use that word loosely, but there is still a flow or a I should say organization to it, right? So you got top level management, which clearly might be what? Your CEOs, right? Those high top executives. And then that trickles down to middle management. So we'll say top level management, and then draw a little tree. And who comes next? Who do you think? These are the middle management or managers on each side. And obviously, if there are middle managers, who do you think falls up under them? Supervisors. Good. That's how the chart looks. Because ultimately, these supervisors are over what? Their own what? What would they have to themselves? Their own department or division, right? So you know how you may go in a factory and they may have management over, a certain division, and that division has about 5 supervisors over separate departments. That's just what this relates to. So the reason why we draw this out, what are we concerned about? If we had a concern or some kind of hiccup or issue, where would we start? Do we stop at the start at the top, or we start at the bottom? Bottom. It's bottom up. That's important. I want to say this on your test. Bottom up. So what that means is, for it to get all the way up to the top level, it had to go through 2 different levels before it got up to there, and that must be a significant or severe issue for it to get up that far, right?
Yeah.
Okay. So budget reporting. What do we mean by budget reporting?
Seeing where you at.
What does the budget have to coincide with? What does it have to be in line with? The accounting period, right? We would not budget for the first 6 months of the year if the accounting period did not run for the first 6 months of the year. If the accounting period runs 12 months, your budget needs to be for what? 12 months, because it has to coincide with it, right? Can't be a shorter time. That means you wouldn't budget properly. What about budget timing? What's the timing for budget? Because you're dealing with manufacturing, how often do you think we have to budget? In a manufacturing?
Monthly.
Monthly. They lose money daily. If they waited 3 months, do you know how broke they would be? They would be broke. A manufacturer, I mean, they're doing production runs weekly. So if they're doing production runs weekly, they have to know on a monthly basis how much they're going to potentially bring in, how much materials they're going to, purchase and use and things of that nature. So they need to do this on a monthly basis. Now, that's just for those continuous budgets. And which budgets out of the list that you were giving me earlier, which ones do you think are more so continuous than anything? Looking at the types of budgets that they have in there, which ones do you honestly think should undoubtedly be on a monthly type of basis?
We have sales, we gotta know how much you're going to sell to.
Right, to stay in business, right? So the sales budget is one that most definitely has to be done on a continuous basis. That production budget, do you think that needs to be done on a continuous basis, right? Because they're using all that raw material. Okay, so turn to 904. When we're talking about the master budget component, how many actual budgets are there?
You have 6, six.
Roughly, yeah, because see, we don't have to really count those financial statements, considering that we knew about those already because we used them in financial accounting. We just know that this time around for managerial, we do, the budgeted income statement or the budgeted balance sheet. However, sales budget, and then they have a production budget, right? Manufacturing budget, a merchandise purchases budget. So they just have so many that are involved before you get up to those major financial budgets such as income statement and balance sheet. So they have a process here on exhibit 22.4, right? And how are we going to say that we were successful in the process of budgeting as far as the master budget is concerned? How can we honestly say we did that successfully? How can we say we did the master budget successfully? Considering that it includes all of these components, all of these different budgets, right? How can we honestly, at the end of the process, say we did this successfully? Say it louder, Ms. Taylor. Right, so what budget does it start off with? The master budget, which budget does it start off with? Sales budget. So that's how you can determine if you did a successful master budget, is because if you got to the end and you did better than what your budget initially said, that's a success. Now, if you did much less than what you said, then we can say maybe that wasn't so successful. Maybe that wasn't a good, because everything else stems from which budget? Sales budget. In other words, if you budgeted to sell 500,000 units and you only hit the 200,000 mark, I don't think that's successful at all, right? But if you go over the 500,000, then that's really good, right? That means you budgeted for at least your break even, at least. So that means you didn't lose any money, but you definitely made more, money.
Expense-wise, it was less.
Expense-wise, yeah. If your expenses are less, then you hit the mark. Good. Sales-wise, if you didn't meet your sales goal, that's pretty bad. Okay. So,
what about
This is one question.
You were going,
What
you know what, people show up early to class and they just got all these ideas, right, and want to throw us all off. Y'all know, can y'all believe he got here at like 5? He got here like 5:15. And I was like, what? You the first one here? 'Cause, you know, normally he's like the first one here. And then he said, oh, I thought the class started at 5 o'clock. How long have we been in here? So what was your question?
What I'm saying is, what about if after the sale budget,
Mhm.
then the expenses, at some portion, the expenses to the investment, like buying, purchasing, like the machine.
Equipment or something like that?
Yeah.
That's still not bad. It's not a bad thing to take money that you have, I guess, profited and invest it into machinery, because what is that going to do for your business?
It sounds to increase the product.
Increase equity, add value, right? So it's always a good thing. I think what we're saying is you want to keep expenses down, and keep in mind when they purchase more machines and things like that, that's not an expense. What is that?
That's
Finance expenditure.
Yeah, that's we don't expense it. Yes, yes, capital expenditure. So what that means is what I'm purchasing is going to add to the value of my business.
Yeah.
So I didn't really lose it as far as an expense is concerned, because we don't expense those types of things. What we expense out of are the small things, right? Salaries, rent, utilities, stuff like that. But if you're purchasing a building or some land, that can only add value to the building. Yeah, capital expenditure.
that's when depreciation comes in.
Okay, so let's start with the sales budget. Sales budget, and it looks like it's on page 906. What are we concerned about when it comes to the sales budget? What is the purpose of this budget? The planned sales, right?
Yeah.
And units, and the expected dollar from those sales. So at this point, what we're doing with the sales are we are estimating the unit sales, estimating the actual unit price for those units, and ultimately we want to do that to fulfill a couple of reasons, right? One obviously is to sell to make a profit. What's the other reasons?
It's meet the expense goal.
But you also want to meet the goals of the market. Okay, so in other words, you have sales going on. You're obviously going to estimate the market conditions before you start making budgets, right? Because if there are other products out there on the market and you're selling way above their price, you're probably going to lose, right? Because that's your competitor, and if they sell lower than you do, then they will pull the customers from you. So the goals are, yes, to put sales at a budgeted amount so that we can sell enough to go beyond break even, but also we want to meet the conditions of the market, right? Merchandise purchases budget. So since the sales budget sets the tone for the other budget, what are we concerned about with the merchandise purchases budget? Right, so basically we purchase raw materials, right? And in the event of us purchasing raw materials, we have to account for the cost of these products that we're completing. So it's not just enough to do a budget to show how much we're going to sell, but how much it costs us to sell it, to produce it and then sell it. And we have to stay at numbers that are reasonably low, because it's all about saving and lowering expenses but increasing sales, right? So how can the quantity that you purchase in raw materials be affected? By what? What could they possibly be affected by? They say it right there under the merchandise purchases budget on page 907. Safety stock and what else? Just in time, right? So with just in time inventory, what does that do for our quantities that we have purchased? Right, so what that does is it enables us to purchase smaller quantities, right? And those quantities generally are delivered more frequently, right? Because they're smaller. But safety stock refers to what?
Protection against loss.
So in other words, okay, if I'm ordering, let's just say plastic bags, right? And no plastic bags are to be a part of a product that is to be made. If we're talking about just in time, we're going to order just enough bags for our order so that it can get to us quickly and that we can produce it quicker and get it out there on the shelf to be sold, right? But if we're dealing with safety stock, what is the lowest amount of material that we can purchase so that we will get it on time so that we do not lose money? Because the later the delivery, the more delayed you are in doing what? Production, right? So we want to make sure that whatever the safety stock is, that we declare what it is, we stick to that and say, I can not order more than this amount of plastic bags because I know if I do, it may be a delayed shipment. It may cost me more money because we all know if things sit are not delivered, then the price does what? It goes up, right? So those are the things that can affect the quantity that we purchase, and that's just only dealing with raw materials. So look at exhibit 22.7. They have a little equation here, and they say this is the general formula for merchandise purchases budget, right? Budgeted ending inventory plus cost of sales for that period minus what? Beginning inventory. Now, how does that work? That's the equation for us to determine the inventory that we have to purchase for a production run. So we're saying whatever we budgeted for the ending inventory, which is going to come from where? And then plus the budgeted cost of sales of that inventory that we're going to order minus that budgeted beginning inventory is going to give us inventory to be purchased. Okay, selling expense budget. What is that budget for? And I'm on page 908. What kind of expenses? So the types and amounts of selling expenses expected, right? What type of expenses could that possibly be?
Commission.
Sales commission, right? Those people normally with manufacturing companies, don't they have a selling department, right? That only goes out there sole purpose and their sole job is to do what? Sell the product once it is completed. So that's pretty much a good easy budget to do, because if you look at exhibit 22.9, they start off with what their budgeted sales are. Clearly the sales commission is 10% for every person who sells the product, and they calculate the budgeted sales commissions. So in other words, when they have 10,000 there based on those sales that they want to make, they're saying for each one of those people, 10% of what their budgeted sales is what they expect to pay out as far as commissions is concerned, right? And then salary for sales manager, we know that is what type of cost?
A general administration.
But is it fixed, variable, mixed?
Mix, it depends on.
It depends, right? Based on what? Total what?
The sales and the units.
Fixed cost per unit. You remember how the behavior went in the last chapter? So if volume increases, what happens to fixed cost, total fixed cost? Does it change? Or does fixed cost per unit change?
Fixed cost per unit change.
Right, based on volume. So that's what we're saying here. Notice for salaries for sales manager, it was 2,000 for October, 2,000 for November, 2,000 for December. And what happened? So it stayed constant through what? No matter what the volume was, right? So we can honestly say that was just a true fixed cost because this time it didn't vary for that salary for the sales manager. Now, with the sales commission, obviously that varied based on what? The volume of sales. If it increased, the commission increased. If it decreased, the commission decreases, right? General and administrative expense budget. Who falls under that? Who falls under the general and administrative expense budget? Because it's definitely not the hourly factory workers, right? Who falls under that? Who's in general administrative? People like the secretary, right? The janitor. Yeah, you. If you want to be the accountant, right? You fall under general administrative budget. So how do we determine whether your costs are fixed or variable?
It's fixed.
How do we know it's fixed? He tried to get it out, and I know he's gonna say it. How do we know that the general and administrative people are not one day, 1 week they get 500, the next they get 2,000?
They are not hourly, and then they are not related to the production.
That's it. That's it. They are not directly related to producing the product. And if you're not directly related to producing the product, you fall up under that what category? You got direct labor and you got indirect. The indirect falls under overhead. So the people that are in the general and administrative expense budget are people who fall under indirect labor because it is not directly related to the production of the product. And we know their salaries are fixed. We know they don't get paid by the hour. Probably, and even if they did, it would probably be what? A standard 40-hour work week. They probably wouldn't get any more than that. So what they've shown you here in 22.10, they showed you the administrative salaries, which you notice have not changed from month to month, even though we know production is going up and down, right? Depreciation of equipment also falls under general and administrative expense. Why is depreciation falling under that? The equipment does, but the depreciation of it does not, right? Depreciation, the only role it has is the loss in value, right? So we cannot honestly say that because it is the loss in value and because it's loss in value on an asset that is actually used in the factory, that's not the only thing that depreciates in the factory. What else depreciates? Not just the equipment, everything depreciates. If it's a copier, it depreciates, right? That's sitting in there with the secretary or the accountant. It depreciates. The building itself depreciates. The land that it's on, you know, after a certain amount of years, they depreciate. So we still consider it what type of cost though? Fixed. Now turn to page 910. We're going to talk about these capital expenditures, right? And what did we say the capital expenditures were? Mr. Dasu mentioned it when he was talking about us purchasing or investing in machinery and equipment, right? And plant assets, right? So we have to make a budget for us allocating our money to purchasing new things, new assets, right? It's not that it's needed every single month, but we cannot dictate when a machine may break down. We cannot dictate when a machine has just completely reached its end. I mean, we can put a useful life on things, but that is not a definite. It's just a reasonable estimation of years, right? That it may or may not last. So we have to budget for that And in the midst of us budgeting, all we're doing is making sure whether or not we need to acquire new equipment. It's not a budget that may have to be completed every single month. That may be a quarterly type of thing. Maybe you only evaluate your machinery in the factory every 3 to 6 months. That's expected, and I think it's reasonable. Cash budget. How important is the cash budget? She said important. Very, very. Why is it? Everything just ultimately, yes, we do the cash budget in order to prepare the other budgets, right? But ultimately, it comes down to that cash budget because we all know cash flow is important. You can be a profitable company just because it says you have a net income, but if you have a negative cash flow, what more can you do with the negative cash flow? You can't do anything, right? So what they're showing you here, Exhibit 22.11, beginning cash balance plus what? Receipt, basically what you purchased, right? Minus what you paid out, and that's going to equal your preliminary cash balance. Now, if it's adequate, we all know what adequate means. That means that you can pay your bills, right? And if it's too low, if you budget too low for your cash flow, that means what? Not only can you not pay your bills, but what else can't you do?
Your company will close.
You won't be in business, right? So the bills, I think, are the least of your worries. As soon as you say there's no more cash, all employees stop and leave because you can't pay me and I don't want to stay. That's how that works. Okay, so looking at cash receipts, they show you Exhibit 22.12, right? Budgeted cash receipts. So what they show is their budgeted sales, right? And it says less ending accounts receivable. They have to account for that. Some businesses will have it where, they will put customers on credit. And so we have to account for the possible receivables every single month. And then they have budgeted, looks like 40% of cash sales, that's how much they're determining would be receipts or what they would potentially receive as far as cash is concerned. And then they also show collection of the prior month. So that's the actual number. Whatever their collection was from the previous month, they incorporate that into this budget. Now, cash disbursements, that's a little different because instead of looking at sales, what are they looking at? Purchases. So what they've already anticipated to spend money on for that month. Now, they show current month purchases. The reason why you have 0 for current month purchases is because this is a budget. You have no idea what will be purchased, right? However, you can base your budget off of what happened in the prior month. So if you know you spent a certain amount in the previous month, that's how you're going to base your budget for the next month, because either you're going to do the same production of units or you're going to do what? More. Okay. And so that's going to show you what your disbursements are going to be. Next and lastly, 9:12 through 9:13. Now we get into the interesting budgeted income statement and balance sheets. These numbers ultimately come from where? For these two financial statements. All the other budgets you did, right? The master budget components. So that's why it's important for you not to skip around on what budget you need to do. You have to go in what? Order of the process. Because if you go out of order, when it gets time for you to do income statement and a balance sheet, you're going to be missing some numbers. If you look at that income statement, what are the things that they pulled ultimately from the other budget? Sales, obviously, because you have a sales budget, right? Cost of goods sold, did they pull that from another budget? No. All they did was took what was from the sales budget and calculated what their potential cost of goods sold would be, right? Then sales commission, sales salaries, all these different expenses, depreciation, all of those came from previous budgets. Same thing with the balance sheet. All of those things came from previous budgets. So that's why it's so important to follow the process the way that it needs to be, because otherwise, you're not going to be able to accurately tell if you did what. We just talked about it right before we started all the discussion. You're not going to know if you were successful in the process, right? Okay, what was the problem in homework that?
Exercise 3 and exercise 4.
Exercise 3 and 4.
Yeah.
Oh, yeah.
Yeah,
But
Barb's on it too.
I mean, this was the only one that I got it now.
Oh, you.
What I did was I took the money out the same, the percentage out the same month twice. You know what I'm saying? But what was it? I wish I had my computer. I probably bring it, but I did.
I think it's from 4.
And I see in September I'm supposed to carry it over to the bottom of the other.
4.
Okay, so they're asking us, it says exercise 22-3. Use the following information to prepare the July cash budget for ACO Company. It should show expected cash receipts and cash disbursements for the month and the cash balance expected on July 31st. Tell me again when the homework is due.
Tomorrow.
So I'll extend it until Friday. Okay. Somebody remind me of that before we leave. Otherwise I will forget. No, you probably would have just emailed. I think everybody else does. All right, so we're supposed to prepare a cash budget. So hopefully in your book, you know what a cash budget looks like. If not, just go back to that page in your book so you can have a guide. What do we start off with first? Is it budgeted sales or is it just?
Oh, cash receipts and sales. I'm sorry.
Beginning balance is 50,000.
Beginning cash balance. So beginning cash balance. And I believe Ms. Cedro said 50,000.
Yeah.
And what goes next?
Cash receipt.
Oh yeah, cash receipts.
Cash
Sales.
receipts is B. Cash receipts from sales, 30% is collected in the month of sale, 50% in the next month, and 20% in the second month after sale. Uncollectible accounts are negligible and can be ignored. Sales amounts are May actual 1,720,000, June actual 1,200,000, and July budgeted 1,400,000. So we have to calculate what is going to be the cash receipt based off of that information that they've given us, right? So I think I'll do it over here in this area on the side. How are we going to determine the total amount of receipts based off of that information? May, the sales were what? For May. So for May, they were 1,720,000, and we need to multiply that by 30%, which gives us what? 300,000.
I have a question.
Yes, ma'am, Ms. Cedro.
It say it's collected in one after sale.
Yeah,
Wouldn't that be for?
Hold on. It says 20% in the second month after sale. So if May was the sale, no, when was the
July
sale?
was the sale. Cause that's when the price is first.
So the next
No.
should be-
Not July, May come before July.
Oh, so June.
No, it's gonna be August. It's gonna be August.
We
No,
don't have
I
August.
think you're reading it wrong.
Because when I was doing the
Let's say,
earnings, right?
Right, but in this case, and I'll just tell you, you're gonna have to go backwards. Why do I say that?
Because we know the unit balance of July. From there we can go backward.
Because they're giving you actual, amounts, right? And so you have, if you purchase in May, what percent would you use?
60% on, you said purchase?
If you purchase, not purchase, but if the sales were in May,
Yeah.
what percent would you use?
30%.
Why 30%?
Because that's what
Because
it says, so let's be in
listed
the
on
month
the
of
month
sale.
I'm thinking it's 20.
But how do you know they're talking about the month of May for that?
In the B, they say cash receipt from sale, 30%
Yeah, because it was
is
in May.
collected in the month of sale.
Uh-huh.
That one letter also.
Okay, I think we're working with July because that's when the car is disbursement. So that's the month of the sale. July is when the car.
I think what you guys are doing is you're confusing yourself because you want it to be 30%, but I'm here to tell you that it is not 30% that you should use for May, and I just want you to tell me why. First of all, what are we looking for? What month? Cash receipts?
July.
July. So,
Okay.
if we're looking for July cash receipts,
So 30% is for July.
if we're looking for July cash receipts, and it clearly states here, 20% in the second month after sale, then if it was July that we're looking for, what would be the second month? Or 2 months prior?
May.
May. Does that make sense? Let's go through it again, because I can tell by the look on your faces.
So I'm right, 30% is for
No. We are looking for July cash receipts. And if we're looking for July cash receipts, and it says here, 20% is to be applied the second month after the sale, what was 2 months prior to July? May. So we have to use for May sales 20%. If the 50%, it says in the next month, when would you use the 50%? June. And then 30% for July.
That's what I'm saying.
You kept saying July as in we use the 30% for the month of May.
No, 30%.
Okay. But we're on May right now. And I kept asking what is going on, what's the percent? You guys said 30, but it's not 30. What is it? 20%, which means that it's going to be what? 344,000. And then for the month of June, what were the sales?
1 million.
And we're going to multiply that by 50%, 600,000. And then the month of July, the sales were
1,400,000.
and we're going to multiply that by 30%, which gives us 410, 20,000. Okay, so when we add all three of these numbers up, what should be our receipts? Cash receipts from sales.
1,364,000.
1 million.
1,364,000.
Okay. All right. Now at this point, we add these to get what?
The cash receipt.
Mm-mm.
Um,
Total cash available. How much is it? Do I have that right? 1,414,000. And now we've done our cash receipts. Now we need to do what? Disbursements.
yeah.
So cash disbursements is going to be based on what? It says payment on merchandise purchases, 60% in the month of purchase and 40% in the month following the purchase. Purchase amounts are June actual 700,000 and July budget 750,000.
So June is 700,000 times 40%.
Good. So we need to calculate it over here again. We got June. You said 700,000 times 40%, which equals what? 280,000, and then July was 750,000, I think, times 60%, which gives us 450,000. So we need to add these two together to get how much for payments for merchandise.
730,000.
730,000. And then next we need to also include what other charges. It says here, budgeted cash disbursements for salaries in July were 275,000. So I would assume salaries is next. What does that say? 725?
Yeah.
275.
Oh, 275. What's next? What's the next disbursement? Depreciation. Okay, so
We don't have to include depreciation because
right.
It's not.
It's not we didn't take out cash like that.
In other words, depreciation expense is not a cash expense, right? Okay. However, it says other cash expenses were what?
200,000.
So other expenses, 200,000. What else do they have?
We have active income tax.
Income taxes or accrued taxes. How much were they? 80,000. What's next?
We have bank loan interest.
So interest. How much was the interest?
60,600.
Now at this point, what do?
We subtract the cash disbursement.
Don't we need to add them all first? What's the total cash disbursements? Mhm.
291.
So 1,291,600, right? And at this point, the whole goal of this was to find the ending cash budgeted balance, right? Which should be what? When we subtract 122, 400.
Yeah.
Okay, good. Is the next problem like that as well? Same thing? Different statement?
That's the balance,
Different
preparing
statement?
income
Yeah, this one merchandise.
statement and
Oh.
balance sheet.
Okay, 65%.
Oh, so we're just using the information from this one
Yeah.
to prepare that.
Mhm.
So we're supposed to prepare a budgeted income statement for the month of July and a budgeted balance sheet for July 31st.
Oh, yeah, no.
That's a long one, right?
Well, we got time. This is the last one.
Yeah.
Okay, so first we're doing the budgeted income statement. Remember, you're using the information from the previous
Yeah.
problem. However, sales is what we start with, right? What are going to be the sales?
Sales.
You had them. What month is this for? This is for July. What were the sales in July? From the previous problem. 1,400,000. 1,400,000. And obviously, where there are sales, we must calculate cost of goods sold, which was how much?
55% sales.
Which is, and we can put it over here so everybody will know. 70.
Yeah, 1,000.
How much was the 50%?
700.
It was what?
55%.
55%. He says 770,000.
Yes.
All right. What's the next line? Oh, we have to calculate gross profit. That's a relatively, I know you've heard of it before. I know you have. All right, gross profit, which is just subtracting cost of goods sold from sales, which gives us what?
$630,000.
Okay, so 630,000. All right, operating expenses. They say that the first thing we need to record is salaries. And we need to calculate the salaries, right? Because what it's saying is for C.
How about B?
What do we do with inventory? We took care of that. How do we take care of inventory? Why are we not concerned with inventory?
That's what was left.
What kind of statement are you doing?
Income statement is a balance.
Right. That's taking it all the way back, right? Financial one. Okay,
Well, we're doing both, right?
we're doing both, but right now we're just on what? Income statement, and we just took care of our revenue section with the sales and cost of goods sold. Okay, so operating expenses, first expense is salaries, right? But we need to calculate that because it says salaries payable on June 30th are 50,000 and are expected to be 60,000 for July 31st.
You just add them to this.
No. What is salary that was already paid?
200,000.
It wasn't 200,000. How much was it?
Oh, 275,000.
Paid was 275,000. And how much were the payables?
50,000.
For what month?
June.
June. So that means that was the existing payable, right? And it's supposed to be how much for July?
60.
Now, why am I not subtracting 60,000?
It's not paid out yet.
Right, because this is July 31st, which means the payables were on July 31st and not to be paid until when? August.
Yeah.
So, with this calculation here, how much is this?
Do we add that 60,000?
275,000 minus 50,000 plus 60,000. So, salaries, 285,000. And what's the next expense? What on that equipment? Accumulated depreciation. So that depreciation expense is how much?
36,000.
36,000. What other expenses do you have? You just did all these on the other problem. Do you have other expenses? 200,000. And then what else?
Tax rate.
Interest, right?
What about income tax?
Hadn't gotten there yet.
No, the interest is 6,000. There's, I'm sorry.
Interest.
The bank loan interest. 6,600.
But right here it's saying
6,600.
1% monthly expense.
For what?
Oh, okay.
So right now the total expenses are, because we haven't did the tax yet. Right now total expenses are how much? $527. When you add all these?
That's what I got.
Okay. Now, income before tax. This is why we didn't include the tax shit, right? So, income before taxes is how much? You're gonna subtract the 527 from the 630.
$102,400.
Okay, so 102,400, right? And then now we have to calculate the income tax expense, and the only way we're gonna do that, what rate did they give you?
30%.
30%. So if 102,400 was the income before, and we multiply that by 30%, what do we get? 30,720.
You already gave them.
But you know, in essence of showing you, because I mean, you may have a question, you know, later on that will not just give it to you, which is fine. Doesn't matter. Mhm. So now we have an income tax expense of 30,720, right? And now, in order to get to net income, you're gonna do what? Subtract. $30,720 from 102,400.
$71,600.
So that's just one part, right? And now we still have to do the balance sheet.
So you went back and you get an information from the budget negotiation and you get from me. That's what you do. Yes.
You had to do 22.3 in order to do 22.4. Okay, so now we have to do the balance sheet, which is also gonna come from 22.3.
When are you gonna split up to do?
It'll probably be in another week or so. All right, so with the balance sheet, what starts on balance sheets? What do you start with? Assets, right? And the asset that we have first is cash. And what's that balance? 122,400. Everybody sees where she got that from, right?
Oh, from the pending counseling.
Mm-hmm. Next, what's the next one on the list? Accounts receivable. And how much is that? Accounts receivable, don't we have to calculate it just like how we did those? What did we do? In the last one. Yeah.
So we gotta do the opposite, which would be 70 instead of 30.
Well, no. Cash receipts, accounts receivable, you gotta look at the sale and what rates did they give you?
30, 50, 15.
For a receivable?
Oh, I'm sorry.
When we did those calculations before, For June sales, first of all, what were your June sales?
It was 1,200,000.
1,200,000. And how much of that is going to be accounts receivable?
600,000.
It's gonna be 50%.
Why do you think it's 50%?
It's an extra, it says 50% in the next month, and, if we did, the sale on June, we are going to expect 50% of the sale, June sale, to receive it in July. And, you want to take what,
So if we pay a percent tax, 50% out of line,
no,
Don't we just use that figure for account receivable?
Why can't you? That's what I want you to tell me. For instance, for June sales, what percent did we use to look at the receipt for June?
50%.
We used 50%. And are you sure?
Yeah. I'm looking at in the last month.
Uh-huh.
The cash payment.
You said for the cash receipt.
Mm-hmm.
yeah, we expecting, we did a sale, we did a sale on, the sale on June,
Okay.
one,
So with the 50% in the next month and the 20% in the second month after the sale, what would have been the next month?
Are we working on June or July?
We're looking at July sales, but what we're trying to get to, we're looking for June sales first, sorry, for accounts receivable purposes.
Okay.
June sales of 1,200,000. And last time when we did this, the percents we used is we did 20, 50, and 30, right? But now we have to switch it up, and why? Why do we have to do that?
You have to do 50/50. That's how we doing July, right?
That wasn't my question. My question was, why in the past we were looking at the cash receipt.
Because we're doing it's the balance. We're trying to figure out the
Well, before we did the cash receipts, right? And we went 20, 50, and then 30, because that's the way that it instructed us to do. But now we're not looking at cash receipts. We're looking at accounts receivable. And just because you're looking at accounts receivable, it doesn't mean because you got 50% in cash that you're going to expect 50% in accounts receivable, because that may just not be the case. It could have been a situation where you only collected 50%, but more was coming in cash. Not that the rest of it was in accounts receivable. We're just estimating that. So my question is, for June sales, 1,200,000, what percent are we looking for accounts receivable?
30%.
Why do you think it's 30%?
Sales collected.
Was that the month of sales? We're still going the other way, folks. That doesn't change. If you did it for cash, you do the same thing for, if you did it for cash, you do the same thing for accounts receivable. But something changes based on the month. When we were doing, in basic, just trying to put it to you straight. You can still go the same way with the 20, the 50, and the 30. The difference here is we're not looking for May, June, and July. What are we looking for? Receivables for what? June and July. So what do you have to do differently if you're going backwards?
You just have to use two.
Keep going. That's what we're trying to say. We did not collect in May, June, and July for receivables. What this looks like is that we collected in what month? June and July. Which means that in June we collected sales for June, and when else? And May. So if you're collecting for both June and May in June, what percent do you use?
So you use 30% for June and then 50% for May.
70. That's basically what I'm trying to get to. Yes, 70. So with that being said, June sales were how much?
30%.
No, how much were June sales? Yes, 1,200,000 multiplied by 20% gives us what? Because we running out of time. 20. Going backwards. 240. July sales. How much were they?
1,400,000.
70%. How much?
I still don't understand the 70%.
Yeah.
Because
Because
you add, because it's only two months that we're looking
Well,
at.
those add up to be 90%.
What adds up to be 90%?
Oh, well, maybe it's 50% for both of them.
Folks, it's 70%.
Yeah, 30.
I just need to know what the amount is.
So shouldn't the
We can make sense of it later. I'm telling you, you're running out of time. And if we don't get through this, you'll be screwed on your homework. So, 70%, what is it? You'll go back and figure it out later. It's not making sense now because you're not doing nothing but crunching numbers. How much? So that means the total accounts receivable is how much? 980,000 plus 240,000. $1,220,000.
yeah. So it's not 30% for June?
Let it go. You'll figure it out later, I promise you. Go back and watch this, and you will figure out why we need 70%. But if we keep spending more time on that, we will never get through this. What's the next asset?
Inventory.
Inventory. How much was that? Was that something that we have to calculate, or was it given?
Yeah, that was the merchandise.
Oh, yeah, inventory at the end of June.
Yeah.
It's
But what month are
80,000.
we on?
July.
July. So how much? 60,000.
Yeah.
What's the next asset? Are there any more?
We have those ones to make a
Total current.
Yeah.
Equipment.
That's not a current, but total current assets is how much? 122,400 plus 1,220,000 plus 60,000. Now, long-term assets, was it equipment? What was it?
You said
Don't we subtract that depreciation?
Y'all let me get this.
okay, you said
That's what I'm asking.
ask for it?
What's the long-term asset that you have?
Accumulated.
Or plant asset? What was that accumulated depreciation on?
Oh, yeah, that was.
Equipment. How much was the equipment worth?
600 on July 31st.
Huh? 1,600,000?
Yes.
Is that how much it's worth or the depreciation cost?
We
Yeah,
hadn't
account
got
balance.
to depreciation. We haven't subtracted that yet. How much was it worth?
1,600,000.
So 1,600,000, and what was the accumulated depreciation?
600. I mean,
260,000.
660,000.
How much?
660,000.
280,000.
Folks, This cannot be this
Oh,
hard.
sorry,
It cannot be
$280,000.
this
I'm
hard.
sorry.
First of all, accumulated depreciation, they gave me 280,000. That was the balance as of what date? June 30th. And what month are we in?
July.
July. So we have to calculate what?
We gotta add the 36,
What is that called?
depreciation expense for the month.
Expense. Right. Depreciation expense. So we got, was it 280,000?
Yeah.
And adding 36,000 for the depreciation expense gives us what? So 316,000, that should be your accumulated depreciation expense, right? You obviously need to subtract that from the value, which is how much? $316,000 from 1,600,000.
It's gonna be 1,284,000.
1,284,000, and this amount needs to be what? What is that amount? What's the label for it? Total asset. No, it's not total asset. What is that?
It's less.
Long term. Total long term assets, total whatever you want to call it, plant assets. That's fine. And so for us to find total assets, what are we gonna do? Total assets, current plus long term, equal how much? Now we got to do liabilities, right? What liabilities did you have? What's the main liability you had? If you had accounts receivable, you also had accounts payable. And how are you going to calculate accounts payable? Did they give you? Do you remember when you calculated the purchases? How much did your purchases come out to? No, I don't think they were 730,000. $730,000.
What was the question?
The question was, how much was your purchasing?
Total.
Yeah.
Yeah, that was the for the month of June.
What month are we in?
July.
How much were the purchases for July?
750.
Exactly. 750,000. And what was the percent of that was unpaid?
60%.
No, it wasn't. No, it wasn't. 40%. So 40% times that 750,000 gives us what? I can tell y'all right now. You can just finish this up when you get you out of here. 300,000. So AP 300,000, and where that came from was 750,000 times 40%. What's the next liability?
Income tax payable.
Oh, you had another one. Before income tax. Salaries. How much was salaries? Payable for the month of July. For the month of July. It's in the problem. Letter C.
60,000.
60,000. Now, what was the next one? Income tax payable. What did we determine that to be? We did that from the previous part.
30,000.
30,720. When you add all these up, because this is not it, you just need to add all these up, because these are the current.
How about the bank interest?
Mr. Cedro, you better listen.
Oh.
We're just doing current liabilities. We ain't got to it yet. Because bank loan would be considered what? Long term? Or notes, yeah, like a notes payable. So, how much is accounts payable plus salaries payable plus income tax payable? $390,720. Notes payable or loan payable, we can call it either one. That was how much? How much was the bank loan that we figured out?
660,000.
When we add those two, what do you get? Say it louder. 1,000,000. All right. Last is the stockholders' equity, right? Or owner's equity. Did they say you had any stockholders' equity? Oh, it says here G. Common stock, 600,000. And also, what else did you have?
Retained earnings.
Retained earnings of how much? That was beginning, but we're looking for ending. How do we find ending retained earnings? This is taking it way back. However, you take beginning and you add in what? Beginning retained earnings. What was the beginning amount?
964.
And what do you add to retained earnings? Net what? Income, which was how much? What was net income?
It's
71,680.
So add in 71,680, which gives us how much in ending retained earnings? So that number comes under common stock, right? Let's see. And now, of course, we add these together, and what do we get?
$1,605,680.
1,000,006. What is it? 35.
680.
All right. So of course, our liabilities and owner's equity or stockholders' equity needs to equal to what? Total assets here. Add these together and see if we equal, if we balance. You're gonna add 1,050,720 plus 1,635,680. Do we match?
Yeah.
Okay. Yeah, I think next week is when I'll put you in your groups for the project and have something for you to look at so you'll know it's not due until the last day of class. And you have to look at your schedule and tell me what the last day of class is because I do not remember. 5/5.
Mine's 420.
This is the presentation.
They said that
Yeah.
their project is
What's the last day on the? What day is
due
it?
date.
The last day
Is that May?
it's in April.
It
Huh?
says April.
Yours say April?
I think it starts in April, right?
Oh, yeah, it's due
So May
5/5.
4th, I believe, or 5th is your last day of class.
Yes, ma'am.
And you will have a presentation. I'll just kind of give you a rough and dirty what it should be, what it will be about. You are basically doing a proposal for a bird feeding manufacturer. And you are looking at and going through and doing different budgets for that manufacturer. You're going to be given all of the information as far as the unit amounts and all of that to do the budgets for it. And you're going to make a recommendation on whether or not you think they should produce the bird feeders. And so everybody will ultimately have a different opinion. See you later, Ms. Taylor. Bye-bye. And you will have to present your findings and what you developed as far as the budgets are concerned.
So it shouldn't be one of the groups.
I would suggest you do it in groups. It's too long for you to be trying to do it by yourself. Alright? Okay.
We will have a comprehensive homework group. We have the comprehensive, like yeah.
That's what I was explaining. That's what I was talking about.
Because the last time I did online, last semester I did it online and then it was comprehensive project. You gotta do some homework. That's why I got
No, it was 11:05.
Yes.
You took it from me.
Yeah.
Yeah, because with the online classes, it's much harder to try to get somebody to do a group project online. So we have to do something separate for online students. But since you guys are in class, we have to do a comprehensive group project. Remember, okay, I will extend the homework until Friday. Your test, the next exam, will be on chapter 23 only, because chapter 22 is centered around the project. So it makes sense for you to do a test over that as well. See you guys next week. I'm just glad that we can
What? Are you serious?
Yeah.
heard it yet?
Yeah.
You don't know?